very simply, quantitative easing, as we have thought about it and as it has happened in the US and in Europe, really what it boils down to is central banks purchasing government bonds across the term structure, long-dated government bonds, to drive down yields, the level of yields across the term structure. In the case of the ECB, it's also involved purchasing corporate bonds. So that's really what quantitative easing is. It influences yields and borrowing for corporates and households after cash rates have reached rock bottom levels. Since 2018, our economy has been slowing, and the RBA has cut rates. And as far as growth slowdowns go, I think the slowdown we've experienced, and the global slowdown as well, has been a reasonably pleasant one. And it's been pleasant because consumer spending has been resilient, and equity market returns have been solid. But now the risks are growing that in Australia, the slowdown will deepen. And what that means is the consumer will be brought down. We're at a crossroads now. If that happens, the slowdown will not be orderly and pleasant anymore, and it will probably involve sharply rising unemployment. And in that risk scenario, it is very likely that the RBA will embark on quantitative easing. In other words, they will have an asset purchase program. If we're concerned about a downside scenario for the Australian economy, then one thing we need to be aware of is how fixed income portfolios will behave, whether they will offer some defensive characteristics, because it's probable or possible that there might be some equity market stress if the Australian economy takes a sharper turn down. Yields will probably fall further if the RBA announces that they will embark on quantitative easing. It's not fully priced into markets at the moment. There's still significant downside scope for bond yields, and if that happens, it will mean that government bonds and the safer spectrum of fixed income securities will probably provide that defensive characteristic to a balanced portfolio that they are required often to provide. In terms of corporate risk exposure, if we're concerned, if investors are concerned about the growing risks to the Australian economy, and indeed if those risks rise in the weeks and months ahead, then it's probably what we would recommend is favouring the higher quality spectrum of corporate credit. There's still value in having some corporate credit exposure. Credit markets in Australia have been very stable. In our central case, we expect them to remain stable, but we are being less compensated for risk than we were 12 months ago, and risks are growing. So we do favour the higher quality spectrum. And if we become more concerned about the risks, that bias, that tilt will be more accentuated in our portfolios.